It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, the mayor himself, Your Honor, Michael Becker.
Hey, Paul.
How are you, Michael?
Doing well.
So how's everything in the selling and buying of apartment properties these days?
It's been a good run. It's certainly been pretty active this year. We just sold a deal recently. So let's see, we sold 2 deals this year, and we closed on a purchase of another property maybe 2 or 3 weeks ago as this podcast gets released. So we've I think we've sold 2 so far this year, but we have a few we're about to close on. So we've been real busy, and that's why I have been a little absent on some of the regular podcasts. I've just been out trying to make stuff happen.
Well, you are definitely making the things happen. Michael Becker, who went from loaning money, did over $1 billion worth of bank debt with one of the largest banks in the United States, and jumped over the fence, like the cow jumped over the moon, and went over to owning multifamily properties. So him and his group have owned 5,600 apartment units. That's over 27 different properties, and probably about
North of $100 million,
$100 million?
An equity raise, yeah, for sure.
That's unbelievable. So Michael is an expert, so we ask him the questions about what's going on in the multifamily business. Other thing is, what's going on in the Old Capital business?
Obviously, you've been beating the drum for months and months about the Old Capital Conference, which is coming up on September 13th. Really, what I want to highlight is it'll be coming up very shortly when this podcast airs. I'm actually going to be in person in San Jose. With Paul and I are going to go up to San Jose with our buddy JC Castillo and the Apartment Investor Network, which is a group that JC kind of runs in conjunction with Paul up in the San Jose area. That'll be the evening of August 16th. You can find information at oldcapitalpodcast.com for both events. I'll be up there. I think we're going to talk about doing profitable deals in late stage markets. So if you guys are in the Northern California area or have the ability to get to the Northern California area, August 16th, that would be a great event to go to, and should be 100 people or more at the event. So we're looking forward to seeing our friends up in Northern California.
If you have a question, that's a great time to shake Michael's hand, talk with him a little bit about how he does business, how his group at SPI does business. And so I think that would be a good idea to go out and see Michael at the DoubleTree Hotel. So Michael, you do a lot of buying of apartments. Question that came in this week is, Michael, I want to buy an apartment building, and what do I need to look at when I look at the numbers? Do I look at the income, the trailing 12, the trailing 1, the trailing 3, and about these expenses? Can I use pro forma expenses the way I'm going to run it? Tell me, how do you use these numbers and how do you qualify?
So there's 2 kind of ways to look at it. So how you guys are going to underwrite the deal, to kind of how you're going to operate, and then how the lender is going to underwrite and operate the deal. And so there's a lot of similarities, but they're certainly different. So what Old Capital does here is we're a commercial mortgage broker, as everyone knows. And so we really kind of focus on how the lender is going to really underwrite the deal, so we can then back into the loan proceeds and the rate and term and things like that we can be able to provide the clients of Old Capital for debt. So really the way the lenders look at these deals, really what they would need is a T12 and a rent roll to size these deals. And what they really look for specifically on the T12, and what T12 means is a trailing 12 financial statement. So it's the last 12 months worth of operations broken down monthly. So you see all the income expenses by month. So you kind of see the trend line. So really the way that the lenders underwrite is they take T3 rental income and annualize it. So they'll take the last 3 months worth of rental income and, take that, add it together times 4. Then from there, they'll add the other income, the T12 of the other income. So all the other income like parking and utilities and, application fees, things like that. And they'll just take that as how the last 12 months have operated the property. And they take that number to get their gross potential, or their EGI, effective gross income, their total income. Those are 2 numbers how they put together to kind of come together with what the income they're going to underwrite to. And then they'll go into the expenses, and then they'll take some historical information from the seller, and the rest of it they'll use market or pro forma expenses. So what they tend to use from the sellers is really just utility costs is one of the big ones. So they'll actually go through and what the historical utility costs are. They'll go in. Pretty much every other expense will have with the assistance of the appraiser will come and do like a pro forma expense on kind of how they think whatever the market is going forward. So that's kind of really where our part of this deal comes in from what, an effective ownership group, what an effective commercial mortgage broker can do is really coming in and trying to do our best to make sure that we minimize some of these expenses from underwriting standpoints so we can maximize loan proceeds. So one of the things that we're, certainly Paul and the guys talked about on the lender quarterly roundtable that we had 2 weeks or so ago that aired was some of these deals are now getting debt service constrained, meaning that the loan proceeds are being cut back because the underwriting expenses are a little bit higher. So some of the things that have been a challenge we've talked about here recently, just rising insurance cost. So the way the lender is going to underwrite, they're going to underwrite to what your actual insurance quote is that you get from your insurance broker. So you need to make sure that you do your best to shop that as hard as you can, because that's what's going to underwrite to. They're not going to underwrite to some sort of static number. So whatever the seller has is immaterial to what the lender's going to underwrite. They're going to underwrite to what your quote is based off of their insurance requirements. Another thing would be on payroll. So, if the current owner is running a thing real lean, maybe they're a mom and pop and they do a lot of the work on the property, but don't actually charge themselves or pay themselves a salary for it. The lender's going to underwrite to what the market payroll is going to be. You got to be able to support that. So that's one of the things that I think, that separates some of the better borrowers, the better mortgage bankers out there from the others, is to be able to provide some justification to some of these expense comps to help the appraiser justify some lower expenses. You can then increase your loan proceeds. So that's it. And then taxes is obviously one of the bigger expenses, especially in the Texas markets, making sure that, that the taxes are underwritten properly, that just because the taxes are low, they know that you're going to have an adjustment at some point in the future with taxes when the county realizes the property's sold and they're going to come in and reassess it. So making sure that you kind of navigate that with your lender and making sure that you're being as aggressive as you can on your future pro forma taxes really kind of help the loan proceeds out. But those are some of the things that they look at. So it's T3 rental income plus T12 other income over pro forma underwritten expenses from the lender. That's how these loans, that's how they derive NOI, and that's how they kind of make sure if the loan is getting debt service constrained on top of just the loan to value constraints they have.
So typically we're looking for a 125 debt coverage ratio. 125 debt coverage ratio means that we have to have enough NOI to pay the mortgage on the property. So that is a big thing. And talking about that, we just came across something probably about 2 hours ago, which I thought was funny. Talking about insurance. So we're just ready to get a loan commitment, and the borrower shows us his insurance, which we thought, and we were told it was $17,000 annually for the insurance, and it came out to be $34,000. So it went from 17 to actually hard written from his insurance broker, $34,000. And what that did, because we were already probably at the top range of the 125 debt coverage ratio, what that did is that it lowered his proceeds, his loan amount, from say 2.75 down to 2.5. So $270,000 reduction just because that line item of insurance doubled. So make sure that you try to get your expenses in line as quickly as you can so you can share that. That was one of those things that we had a place saver, and we thought it was going to be $17,000 because that's what the seller told us, and that was what the indications were coming back from the insurance broker that the buyer had. But when push came to shove, it was $34,000 and cut the borrower's proceeds down by $250,000. So that's a surprise. That's a surprise, Michael. We don't like surprises, do we?
No, not those kind of surprises, at least. So, just making sure that as we, get longer and longer in the tooth of the market, these are some of the things that are becoming more of a challenge from a banker's perspective, from a lender's perspective, because the agencies are doing a pretty good job of holding their credit criteria and their standards pretty tight to kind of normalized, very prudent standards is what's still in the marketplace. So we're not seeing a whole bunch of looseness with the underwriting criteria, unlike 10, 12 years ago where they were doing dumb stuff. The lenders are pretty conservative still. So what that is causing is some sizing challenges. So having a professional on your side to do your best to mitigate these issues is certainly something that I would encourage you, if you listen to podcasts, reach out to Paul or one of the guys at Old Capital, and we'll do our best to make sure that we provide the best results and navigate through the difficult environment that we're starting to get into from a lending standpoint.
If somebody wanted to get more information about you, Michael, and what SPI does, what's the best way for them to get in contact with you?
Yeah, really the easiest way, besides coming out and seeing me in person. If you guys hear this in Northern California, on August 16th, we'll really just go to my company's website, which is www.spiadvisory.com. That's SPI like spy advisory.com. There's a contact us form. Fill it out, and I'm always happy to have a 10 or 15-minute telephone call with listeners of the podcast.
That was the mayor himself, Mr. Michael Becker. I'm Paul Peebles. Have a great day.